So Mike Wilson is with us. Every quarter you come on, regardless of what's happening, your work is extraordinary, as we've said. Dan mentioned you just got voted again #1 in what? What is that thing?
II, #1.
Which is remarkable because you know why? That's your peers that vote on that, and they obviously think the world of your work, as do we. So as we sit here with the S&P 4550 thereabouts, it's surprising me. Where do you sort of gauge things right now? Because I know your thesis hasn't changed. And quite frankly, all the things that you thought would happen are actually getting worse. It's just not manifesting itself in the stock market.
Yeah, it's been an interesting year, frustrating, as you say, because the fundamental call that we've had has actually played out in spades through most of the economy. Now, of course, there's these 10 stocks that have done a terrific job of managing costs, and that's effectuated a pretty good earnings recovery for the S&P because there's such a large weight in that. But the average stock and most stocks are not having a good year because it's a difficult operating environment. The earnings picture is pretty crummy. The macro environment is, I say, tenuous at best. The only thing really going for the market right now is that we're at the end of the Fed hiking cycle, and we're doing the Pavlovian response for like the 5th time, by the way, since a year ago. We made that call that, of course, almost took Danny to the hospital a year ago, where we got bullish. We got bullish on the Fed pivot a year ago. Okay, it kind of worked into the year end. And then I feel like we've had the Fed pivot call like 4 times, and then this is the next one. This is probably the real one. This is the one where they actually probably are done. They probably did their last hike in July. So let's go back to October, because September and October, I felt like, okay, the thesis really is playing out. I mean, we started seeing all the very interest rate sensitive parts of the market really take a walloping. I mean, the Russell was down 20% from the July highs to the October lows. The S&P equal weight was down 15. Even the S&P was down 10. The mega caps weren't trading particularly well. And then we had this incredible reversal in the bond market. Now, some people will say, most people will say that was Powell getting more dovish. I don't agree with that. I think Powell's just kind of saying what he's always been saying. I think what happened was the bond market was very offsides. People were very short the bond market. There was nobody willing to step in. And then what I would argue is the Treasury, they orchestrated probably the best short covering squeeze I've ever seen in my life. I mean, they basically guided to this coupon issuance that last summer, and then they kind of issued to a less number, and that's all it took. And then you got a lot of real buying on the back of that because, look, at a 5% 10-year, there was a ton of money waiting to make that trade. And so here we are, 70 basis points lower. And I think that explains probably 90% of the rally that we saw in November. I didn't catch it, so bad on us. But it doesn't change my general view that we're still in a very late cycle environment. The Fed is finished, sure, but be careful, what that really means for growth next year. And it's not a good sign for growth.
We're going to talk about growth. You had a note out, kind of giving your 2024 sort of targets and looking out even beyond that 2025. But just talking about the 10-year and that move that it made from, let's call it the start of September, in and around 4%, right? Up to 5%, right? So that was at mid-October or so. And that's when we had the S&P careening lower. Like you said, it was down 10% from its summer highs here. Now, here we are, and we're back at those levels. We're back at 4.3 or something like that in the 10-year. But the S&P is 45.50 or so, right? So it's up 11% in a straight line. I think it's like 3 weeks or something like that. So what is it discounting right here? You've said that we've had that Pavlovian response a few times here. I feel like if all the things that you're looking at from an economic standpoint are going to start to come together as we get into the new year, the stock market is not discounting a whole heck of a lot right now with a 13 VIX also.
Yeah, I mean, part of the stock market is, right? Once again, we have this tale of two cities where the lower quality securities are trading poorly. Yeah. So look, this is classic. This is exactly what happens at the end of the cycle, which is it gets very narrow. The market gravitates towards high quality things that they think can actually generate the earnings growth. Now, this year was a special situation because last year, these 7 companies that everybody's in love with did a terrible job of managing costs in 2022. So that set them up for a very easy comparison year now. So 24 is going to be harder for these companies. There's one in particular that has real top-line growth acceleration. The other ones don't. It's a cost-cutting story. So it's just going to be harder now for those companies to continue to generate the earnings growth that they did this year off of the more difficult comparisons. So look, I think we're discounting a softish recovery with some reacceleration next year. our economists who aren't looking for recession, okay, aren't looking for any reacceleration. Okay, and I think that that's actually the worst outcome is you get like a 1.5% GDP year next year. Companies don't really fire people aggressively. You don't have a recession, hard landing. But the Fed also really can't cut that aggressively. So right now, what's priced into the curve is about 3 cuts next year, starting either in March or in June. That's not really going to be enough to get these weaker companies off the mat, in my view. So for now, you just want to stay up the quality curve. We're waiting for the event, the final blow, to either send us into a recession or some indication that there is going to be a reacceleration, like some exogenous positive shock, which I don't really see. But I mean, we can make one up, but I don't really see where that's coming from.
So, Mike, you mentioned at the opening here that the earnings came in 2023, or will when we're all said and done, a little bit better than expected, and it's very, concentrated in kind of 10 names. Wouldn't that argue for a lower multiple on the S&P itself? Meaning, at some point, those probably are going to, come in a little bit or moderate if these other companies don't catch up. Because I noticed that I think you're on a 17 multiple kind of target, I believe, for your 2024 number, I believe, if I'm not mistaken. Yep. The number. Can you talk about that a little bit?
Yeah, so that's been our call really going back a year, was that we said the rates have normalized, so multiples should normalize. And we think 17 times is the right number in a normal world, right? Not an extreme world, just normal. And let's just do the math on that. In a world where the Fed is not restrictive or easing, that's a 2 to 2.5% Fed funds rate. That's our star. Okay, then you put term premium on that, so maybe 1.5 points for a 4-year, 10-year. And then a 200 basis point equity risk premium on top of that, that gets you like a 16.7 multiple. That's the math, okay? Now, of course, it's hard to predict multiples, day to day, but that makes sense to us. And that's why we were always at 3,900 for end of the year, because our earnings forecast for next year hasn't changed. It's 230 times 17. Right now, we're trading closer to 19 times. So to your point, yeah, we think the market, is overvalued right now because it's just either discounting way more aggressive Fed cuts without a recession, or it's discounting some kind of better growth scenario where earnings are much higher than 230, but more like 250. And that's just not what we're modeling.
Mike, you mentioned Pavlovian response. We've used that term a number of times on the podcast, on our market call, and I agree with that. And it's very one-dimensional thinking, but it's working right now. But if rates go precipitously lower from here, my sense is it's not because something good happened. It's because something's probably breaking. So what do you want? If you're bullish right now, do you want yields just to stop moving, which, by the way, hasn't happened because bond volatility over the last 2 years has been significant? What are you looking for in the bond market right now for the bull thesis?
Well, I think rates need to at least stay here and maybe go lower. I mean, I think rates towards 4% is not a problem as long as it's happening in kind of an orderly way where there's not some event or shock and the front end is collapsing. What'll be really a bad sign is what happened in March. Okay, so in March, the bond market kind of went to the recession call. And what happened is the front end, so when I say front end, I'm talking about 12 months and in, collapsed, right? That's the bond market saying you guys are going to be slashing rates because we're having a hard landing. That's, so if we go to 4%, but the front end kind of stays controlled, like it's not plunging, that's fine. And that would be bullish. And I can't rule that out, by the way. So if you really want to get tactical, okay, like what I would say is I believe we're going to have we're going to give up some of these gains from November because month end is today. People will kind of protect. I think we'll probably sell off into the first 2 weeks of December, typically a seasonally not a great time. I'm very confident that companies are walking numbers down now. I mean, because the fourth quarter numbers are still too high. So that'll get into the market. And then I can't rule out, one last push in January because all the 401k money comes in. There isn't an accident yet. And, once again, Pavlovian. And if rates continue to come in early part of next year, because remember, there's a lot of duration buyers too who've been waiting. So there's money. There'll be money coming in January. That'll probably take yields lower initially. Stocks will like that. I could even see small mid caps doing a little better for the January effect. And then I think you really got to be, concerned.
Mike, help our listener, help me out actually for a second here. So if you look at the 10-year yield, okay, it got above 4% and then went straight to 5% as we just discussed. Okay, this is a matter of months. This is really since the summer, right? But Fed funds, to your point, the last increase that the Fed did was back in July, and the upper band is at 5.5%, right? So let's just assume that we have a 10-year that settles in at 4%, 4.25%, wherever the heck it is right now. but the Fed doesn't indicate that they are going to be cutting, anytime soon for a whole host of, they could be very technical sort of. What sort of impact would that have on just the business cycle in general, right? Because like yields weren't that high for that long, above 4%, right? But Fed funds has gone up at a pace that we have not seen in 40 years, right? And if it were to stay above 5%, what I'm saying is, isn't that like really restrictive in and of itself, that spread between the 10-year and Fed funds?
Yeah, I mean, the higher for longer is when it starts to really bite. And the reason we didn't have a problem this year is because we haven't had to refinance corporate America yet, right? That's next year's business, right? I mean, people have termed out their debt. By the way, most consumers' biggest, debt is their mortgage, which is fixed. So that's why it hasn't really started to bite yet. But it is starting to bite now. It's starting to bite in interest rate sensitive demand. For example, housing demand, auto demand, anything that requires, borrowing. That really is falling off a cliff now. So next year, if the Fed doesn't cut significantly and 10-year is 4% or higher, and you got to recapitalize corporate America and the Treasury, okay, that's the big one. If you got to recapitalize the Treasury at 4.5%, 5% over the next 12 months, that's a lot of money. You're going to crowd out a ton of investment. So that's why the soft landing is actually probably the worst possible scenario for stocks. It's because the Fed can't actually cut enough to create the windfall that we need, or the tailwind we need for all this refinancing. It has to happen in 24 and 25 and 26.
Mike, one of the things that took the 10-year yields from 4 to 5 in a straight line, I think, was this whole idea of these auctions from the Treasury, supply and demand, who's the incremental buyer going to be. And as you just mentioned, potential soft landing is not a great outcome. I agree, because if tax receipts come in lower for the government, et cetera, our fiscal deficit's only going to get worse potentially. At what point does that start to overtake kind of the equation for bonds? Because to me, we saw a glimpse of it a couple months ago, and that's the scariest. That's the abyss right there that we're kind of looking into. Do you expect that to happen again?
I think that the single biggest risk for next year that isn't really being taken seriously is this idea that the government's going to have a really hard time funding itself given the current budget. Okay, like they haven't made any progress on budget negotiations. So let's just assume that we have another $2 trillion deficit next year. Okay, they got to issue $2 trillion of paper net, and they probably got to refinance $5 to $7 trillion, meaning they got to refinance at a higher level. That's an incredible increase in interest expense. Okay, and at some point, the bond market. I mean, we already saw it push back in the third quarter pretty significantly. Term premium went straight up from when they started announcing they were going to do more coupon issuance. And we saw, 100 basis point increase in the term premium. Yeah, why couldn't that happen again next year? People think it's crazy to say this, but I think it makes, how is this any different than what happened to the UK in the third quarter of 2022? I mean, the bond market pushed back, and guess what? The government had to cut spending. So, I mean, we're kind of in that position now. Now, the Treasury bought themselves some time here with this, big rally in the back end, some breathing room. But I'm not comfortable at all that that's not going to resurface again next year, particularly once the reverse repo is fully drained. And that's probably going to be drained sometime in the second quarter of next year. And then how do you fund this thing? Who's the natural buyer?
Well, it's interesting. You're talking about the repo market. It was September of 2019. I think the day was the 17th or so. It doesn't matter. But what you're talking about blew up overnight. The overnight repo market blew up. And that, to me, set the stage for that we subsequently saw in 2020, COVID notwithstanding, but that was sort of a catalyst to me. So what you're talking about, something we should absolutely be watching for. With that said, people get on the rating agencies. I get it. They're always late. But what you're talking about will almost by definition force Moody's and S&Ps to do something in terms of their U.S. credit outlook yet again. Is that a potential catalyst that nobody seemingly is talking about?
Well, it's all part of the same story. Meaning, look, we've overspent our means. Okay, it started actually, during the COVID lockdowns, and it got worse post the COVID lockdowns, and we just kept spending. And we have peacetime, deficits of 8% with unemployment, near 4%. I mean, these are numbers that we've never seen before. So what happens if it looks like we are maybe going into a recession, or just that maybe tax receipts aren't going to be as good? The bond market's not going to like that.
No.
I mean, it's just not. It's just going to push back. And I mean, as Bill Clinton said back in 1994, said, when I die, I want to come back as a bond trader because they got all the power. He was right, because, I mean, the bond market can dictate, the government's behavior. And I think it already is. I mean, it dictated the Treasury. They were going to issue more coupons, but they couldn't. So they found a way to finance themselves. They've got this reverse repo smartly, by the way. I mean, the one thing the Fed did that was smart was when they were doing QE in 21, they socked away some of that money. They soaked up those reserves by paying a higher interest rate to create kind of that slush fund, if you will, for a rainy day. Well, guess what? It's raining. Okay, we got to fund the government. So they're using it now, and it's working exactly, I think, to their plan. I think the risk is that they spent more than they thought they were going to because their tax receipts weren't that good this year, meaning the reverse repo is being sucked up faster, I think, than what they anticipated. And in other words, it's not going to last all the way through November of 2024, which is what their hope was, right? To kind of get through the election cycle, and then we'll redo it again. So look, this is a very tricky situation. It's going to require some very threading of the needles.
All right, so let's talk about that, because we started this out. Guy mentioned that you were voted by not just your peers, but your customers, by institutional investors. Okay, the number one strategist on the street, and just for some of our listeners who've not been on the street, like this is like it's kind of a big deal. I mean that, and so congratulations on that. And so I think it's interesting. We talked about that bullish call that you made that almost sent Danny to the ER last October. And what was funny about that period, because the S&P was down nearly 30% from its highs, okay? And you came in our pod, and what was it, like a week later, you put out this really tactical trading call. There was fundamental elements, there were technical elements, there was a whole host of things, okay? At that time, most of your peers who had remained bullish the entire 2022, they flipped, they panicked down there. Okay, so I just think that's a really interesting point here. So now we have this situation where we're a little more than a year later. It feels like I keep hearing of all these calls of a new bull market and the like here. And so how are some of these folks who kind of like wink, wink, nod, nod, you know what I mean? They've been bullish the whole time. You know how the game works a little bit. How do they get turned around again? You know what I'm saying? I'm just like playing the Wall Street strategist game here a little bit. And we have a ton of respect for you. Like Guy said, you've come on our pod, I think, every quarter for the last couple of years. You call it the way you see it, and you're willing to say, I got that wrong. I think you've already said that on this pod here and there about this or that or whatever. How does consensus get it wrong for next year? There's a lot of 5,000 S&P targets or whatever, and just give us a sense for like how you're thinking about your peer group in a way, not specifically, but like,
yeah. I mean, I have respect for my peer group, and they respect for me. It's a pretty it's a good industry. I don't think there's mutual respect amongst all of us, and like I said, it's also a difficult job to try and predict a price target on a certain date. It's kind of a silly exercise, but having said that. I do think that this job, because you're so public, does lend itself to getting over your skis. Okay, and let me be the first one to say that I probably got a little over my skis at the end of last year. Feeling pretty confident I could actually call all these trades and stuff. Nobody can do that. Sometimes you feel like you can, and I think people now are probably patting themselves on the back a little too much for, maybe an S&P that's higher for a lot of reasons they didn't identify. Okay, I don't know anybody who really called this year fundamentally and from the market standpoint for the right reasons. So I think there's a little bit of, Monday morning quarterback going on, and I'm guilty of that sometimes too. And I think the way people get twisted around now is that a year ago, or January of last year, okay, I think everybody was not everybody, 75% of my clients were in kind of the recession camp, okay? Of course, that didn't play out this year. And there were some reasons for that were kind of hard to see, number one being the fiscal spend. And now it's the opposite. Now it's 75-80% are in the soft landing camp. And somehow the risk of recession today is lower than it was 10 or 12 months ago, which makes absolutely zero sense to me. Now, it doesn't mean a recession has to happen next year, but how can it be that the risk of a recession is lower 12 months later in the cycle? The Fed is closer to being done. The curve has been inverted for longer. All the signs are there. It doesn't make, like mathematically, it doesn't make any sense. So people have been walked down the plank. Okay, they've been forced to kind of adopt a narrative because the market has forced them to do that. And I think that's the hard part of this job is sort of holding your ground and saying, well, look, the fundamental picture from my standpoint still kind of points to a very narrow market, a low, kind of a low quality opportunity, a low risk reward opportunity from an equity market standpoint, and we're just going to call it like we see it, and notwithstanding the fact that we also understand we got to trade some of this stuff. Like I said, I think we could have a rally again in January after a sell-off. I mean, that's a tactical move. My core fundamental view is that we're probably going to trade a lot lower during the year next year than anybody's in print in right now.
So, Mike, you just mentioned that people are forced. I think that's important, and we've talked about this all the time, that as a portfolio manager in Boston, you can't be in cash. I mean, you have to take positions. You have to pick a sector to overweight or underweight, and they get forced. They got forced in the first 6 weeks of of the year, and I feel like they're getting forced now in kind of the back 6 weeks of the year. The one thing that I really have trouble reconciling, and you just mentioned it, is we go through these periods of unexpected problems that occur. The Silicon Valley Bank, 1% of people were expecting, 2 or 3 or 4 banks to go under, right? But what did the Fed do? They came to the rescue, right? With a $500 billion BTFP. What else happened? The debt ceiling. We had no crisis because we punted until 2025. We keep kicking the can down the road. So my question to you is, it's hard as a strategist to try to figure out what can the magic bullet be? But the magic bullet for the last 13 years has been the Fed Treasury coming up with programs. I have no doubt that TALF 2.0 will reemerge if the funding market sees up. I have no doubt that the Fed will stop quantitative tightening for a period of time if the reverse repo and all the other stuff starts to happen. So how do you convince kind of a market player to say, all right, ignore all the important things and just know that the Fed or the government has your back? Because it feels like we're just Pavlovian in that way. So I know I'm asking the impossible question in terms of but what are your thoughts on that just in general? When will it matter?
Well, I mean, that is the bull case. Okay, like that's the only way I can really get to 5,000 next year is if the Fed basically, says, well, we're close enough. We don't really need to take inflation down to target. We're not going to, we don't really need to make sure that we've got inflation beat here. We're going to cut rates a couple hundred basis points and not only stop QT but QE. I mean, is that possible? Yeah. I mean, as you said, there's no doubt that they'll do that if it gets really bad. The question is, do they do that before it gets bad? And, I can't rule that out. It's an election year as well. There are ways the government has of getting money into the system. I mean, they did it, a year and a half ago when they didn't really need to. Governments do that, and that's not a one party thing. That's a both party. I mean, both parties are guilty of that. So, you have to be prepared mentally for these kinds of interventions that you thought maybe were impossible or that they weren't going to do again this time. We saw it in March. And by the way, I misread that. That was probably one of my bigger mistakes this year, was saying, oh, well, this isn't really QE, but it was kind of a QE program. It was an offset to the QT that they were doing, and it bought us more time on the clock to kind of, forestall a real credit crunch. Mm-hmm. Okay. But now the clock is ticking again, and the credit crunch is resuming. In other words, we're going to have negative credit growth probably in Q4 and Q1, and that's just a very difficult situation for the economy in my view.
It's interesting you mentioned that because, yes, they could throw money at the system without question. And if you look at it through the lens of the stock market, seemingly it's working for this administration. Yet when you poll people, to the extent that polls matter, they say the economy is in a shambles. And the president's approval rating is probably as low as any sitting president's seen in quite some time. So that could happen, but one has to wonder if it's going to change the narrative for this administration, which is another topic for another time. But what is important, I think, for this administration is employment. And that's been slowly ticking up. The leading economic indicators, I think, are down for the last 19 months. We talked to Liz Ann Saunders about that last week. If you look around the edges, the employment picture is deteriorating. It has not manifested itself necessarily in the rate, but I think it's just a matter of time. And personally, I don't think it's going to be linear. I think it's going to be sort of this 3.9, 4.3, 4.7. You're going to wake up one day and we're going to be approaching 5%. That's not bullish. And I think that's what the market might not be looking at. Am I onto something there?
Well, the employment cycle's already begun. Okay, so like whether it's the SOM rule, there's a bunch of different kind of historical precedents. Like we've already crossed the Rubicon in many ways. I like to look at the Conference Board employment trend, and that too is now 16 months in a downtrend, which is kind of past the point of no return. So it's already begun. The question is, when does it become nonlinear, right? You hit the nail on the head.
Right.
That's like the light switch going off. Usually it's an event. Usually it's like it's another financial shock, or it's a geopolitical event. It could have been, the terror attack from Hamas. It could have been that. If oil prices had shot up, that could have been it. That could have been the blow. But it wasn't, because oil prices remained controlled. As horrible as the attacks were, it didn't do much to the economy. Okay, but it could be another shock like that, and that's typically the way it goes. Could that be a year away still? Maybe. I mean, we don't know. I think it's probably not a year away. Now, the other way it can happen is just that these small, medium businesses continue to see erosion in their earnings and cash flow, and eventually they just start laying more people off collectively. The other thing I would point out in the jobs data, which is a little bit of a, it's important, is that almost all the job creation this year has come from the government. It's through the CHIPS Act program, the IRA. That's where the manufacturing jobs have been really hot out west. And then you see social services and things like that. If you back all that out, the private job creation right now is below where it needs to be to maintain the unemployment rate, which is why we're ticking up. So, I mean, we're kind of there. It's just the market doesn't want to recognize it yet in a collective manner because of these seasonal pressures to perform. The rally in the bond market, whatever it might be, we got oversold, so people were out of position. And so the last month to me seems pretty technical. I think the next 2 months or 3 months will be technical. And then, something will happen and you'll be like, aha, that's it. And, I thought it was going to be the regional bank stuff in March, but that wasn't enough. We had enough gas in the tank.
When you think of something happening, okay, so, we've had this conversation with a whole host of folks over the last few months. And again, if the technical reaction to rates coming from 5% in the 10-year down to 4.35 or where they are was to buy stocks, there's a scenario where if you go back to, the rate hiking cycle into the 2000 highs and then the pause there, right? And then what happened afterwards, we all know. When the Fed started to cut interest rates, they cut aggressively. Stocks got cut in half. Same thing happened, obviously, as the Fed stopped raising rates into the financial crisis. There was a pause. And then when they started cutting aggressively, not good for risk assets. Again, and obviously we could use the example 2020, it was a bit of a black swan, right? But if you just look at like a 45-year chart of the 10-year U.S. Treasury or Fed funds rate or whatever, you see we've totally overshot the downtrend that has been in place. So if there's a reason for them to cut, they're going to probably cut aggressively. Do you agree with that or no? And then in that scenario, what does that mean for stocks? Because the last few times, it wasn't great for stocks. We had a down 55%, a down 55%, a down 35%, right? And last year in 2022 felt pretty orderly, it felt like a manageable sort of sell-off. And now I feel like we are the mirror opposite in 2023 of what happened in 2022. And I feel like something's got to give in 24.
Yeah, well, I mean, look, here's the historical precedent. So, and this is what people are excited about. So in the last 4 cycles, okay, they were non-inflationary cycles. And the Fed, okay, when they cut interest rates, the market always goes up for a period of time, for like 3 to 12 months. It's usually quite good. And that's what people are looking forward to. The problem is that in inflationary expansions, like 69, 73, and 80, okay, it didn't work. Because by the time the Fed's cutting, it's too late. They can't proactively cut interest rates in an inflationary expansion. And that's, I think, the piece that, like a lot of clients, we talked about this all the time. I think they look at our data and like, that's interesting. I hadn't really thought about that. Some are already onto it because they're smarter than we are. But I mean, but I don't think most stock operators appreciate that this cycle is different than the last 4. And so the typical playbook of the last Fed cut and then or last Fed hike and then a cut is always bullish. No, it's actually not. It's actually very bearish. So if they start cutting in March, that's probably a really bad sign. And I think that'll be part of the process. So here's a scenario which I've been kicking around in my head because, I'm trying to think of all the permutations. This is sort of my top scenario, which is that the Fed probably is cutting rates sooner rather than later because the data is going to get worse. And they're going to react to that. I mean, unemployment's going to keep going up. And they're going to start cutting rates. But instead of the back end coming down, the back end's going to go up. Why is that? Because the bond market's going to start freaking out that, oh my goodness, we're actually going into recession. We already have an 8% deficit. How are they going to fund this thing? And the term premium may actually blow out. That would be a very unexpected kind of reaction function in the bond market, which would then translate back into stocks in a negative way from a multiple standpoint.
That's black swanny stuff that you're talking about, because that
it's end of cycle stuff.
It's end of cycle stuff. Different this time, just in terms of the absolute numbers associated with them. I mean, we're talking about multiples of what we've been historically in terms of debt to GDP and all those things. So I don't want to get too, hyperbolic here, but that's not a great scenario at all.
Well, no, I mean it's also different than what people are probably expecting. So, look, once again, these scenarios, are speculative. So I would say I'd put a 25% chance on that, but it's not a total tail risk. And we have to think about, as investors, we have to think about, well, what are the risks that people aren't talking about or thinking about, so we can be prepared in our portfolios and how to react to them. So that's the one that I'm kind of zeroed in on now because of what happened in the third quarter in the bond market. That risk is clear and present still, 100%.
Mike, Dan had asked the question when he was talking about last year, how you kind of went against everybody else and you were right on the money, and everybody tends to move the same way. And that's true for every product that we see. How do you measure sentiment? What are the things that you look at? Because survey out today that JP Morgan Treasury cash holders, the largest, one-sided it's ever been. Everybody's on one side of the boat. What do you look at, and what should people be looking at to feel, from a behavioral finance perspective, they can be somewhat contrarian?
I mean, we look at a lot of different things. And I would say there's a couple. We track institutional manager positioning. There's a service, NAIIM. It's a National Association of Institutional Investors, and that's very elevated again. It was actually quite low in October, but they came roaring back. So in other words, they're disclosed, sort of positioning relative to, benchmark is very aggressive right now. The individual investor poll, AAII bull bear spread, that's also extremely bullish again, which is a contrarian indicator. We have our own internal prime brokerage data. We're the largest prime broker in the world, so we can see hedge funds, how they're set up, and they've also added a lot of risk back after being pretty washed out in October. They're not extreme, but they've added risk back. So I would say on a scale of 1 to 10 right now, sentiment's probably like a 7.5, 8. And when you risk adjust it for like the environment that I think we're in, it's probably closer to a 9, 10. I mean, like people have too much length on given how they feel. So for example, like our clients, you're nice enough to mention, our clients did vote for us this year. We have a great relationship with our clients because like our clients are smart, and they're not dumb. Okay. Like they don't disagree with, like they agree with a lot of things that we're saying, and they've had a hard time trading this market too. So if you're being a purist, okay, you're actually investing. You're not like, some day trading, jamook, doing whatever on Twitter. Okay. You're earning real money. Okay. You're actually investing real capital for people as a fiduciary. Okay. It's not a good setup right now, okay, for risk-taking, which is why everybody's crowded into these, what I would call very defensive names. I mean, that's what the Mag 7 is. They're perceived defensive growth, okay? And they had a special situation this year of, an easy comparison and cost cutting, so they were able to generate, good earnings revisions. And so they're doing what they should be doing. They're going to the highest quality kind of place to make money. So that's why I really do believe that, if things start to turn, like the smart money is going to go. I mean, they're not hanging out waiting, because they're kind of in our camp already. You know what I mean? But they have to perform, and so they have to keep exposures up.
Well, those stocks might be defensive, but they're also now, in terms of valuations, at a broad, in terms of the spectrum, they're out there now.
That's right.
In terms of their historical norms and where the broader market is trading as well. But you mentioned risk. The volatility index is something that I think, I don't understand it as well as I probably should. I think it's a much different instrument than it was 6, 7, 8 years ago. But at 13, it's saying something that I think the rest of us are not seeing. Is the VIX even on people's radar screen? Should it be at this point? Or is it just a flawed instrument?
That's a good question. I'm not a vol trader, and there's a lot smarter people who have, a better opinion on this than I do. But what I would say is, vol only works at the extremes. I mean, as a signal, particularly, and when it's high. It can stay low for a long time. And of course, now there's all these different products, and the whole gamma argument, like how desks manage their risk. And So like when you get into these year-end situations, you can find that the indices get pinned around these levels because there's so much exposure on both sides, and then people are managing around that specific number. But then, it can also move, like if that stuff goes away, that the gamma goes away, that's when volatility can spike. Right now, it appears as if volatility is probably, it's in a 13 to 20 range. Like I don't see the 40 spike right now because at year end, there's so much liquidity being put into the system from the Feds, from the banks, to make sure that the year closes out well. And that didn't work so well in 2018, but that was a little bit of a unique situation. But normally this time of year, it's hard to get a big vol spike. 18 was very unusual.
Mm-hmm.
So Mike, one of the new shiny objects is private credit. I love this. It's always existed, right? Private banks have retrenched. They're not lending. No, banks are still lending. They're just underwriting on stricter standards. But this private credit wave, and people think it's a magic bullet. Granted, it's locked up money. All the big banks are obviously involved in raising capital for it, so you don't have to comment on that. But in general, it's still the companies that are the beneficiary of receiving this credit are going to be paying 13, 14, 15%. These loans are picking. So what are your thoughts on private credit? Because people will point that that's either they want to be a part of it or that it's a bullish sign for the economy as a replacement for the banks.
Well, look, it all comes down to underwriting, right? So one thing that concerns me is that in the last, or really since the GFC, the shadow banking system has, exploded. And unbeknownst to me, I learned this year, is that apparently the regional banking system is a shadow banking system because it was unregulated for the most part, which is really amazing when you think about how unregulated that part of the market is. But so if you take the regional banking system and then you take the private credit folks who've really grown up in this Wild West era where capital was kind of free, thanks to the Fed, you have some pretty lenient and probably some pretty lax underwriting, policies that have been employed. And, I think there's probably a lot more bad credit out there all over the place because of those lenient underwriting, standards that have been utilized. So that's what I do worry about that, Danny. The other thing I worry about is that there's this general view that, the private credit folks will just take the place of the regionals. It won't matter. But that's a joke because they don't have the bodies. I mean, like private credit guys are not in position to make, mortgages for mom and pop or loan to small businesses that need working capital, in the strip mall in Peoria, Illinois. I mean, like that's my main concern for next year is that like all of these businesses around America is very fragmented, like are kind of being cut off from capital that they need to run their businesses at a reasonable rate. Okay. And the 13, 14, 15% levered loans and stuff like that. I mean, a lot of that is going to refinance private equity deals. Now that doesn't matter because that just means the private equity guys will make a lower return. Okay. In fact, it's gotten so bad that some of the private equity guys now are actually buying that debt. They're actually saying, well, I'm not giving 18% with a pick rate, to somebody else. I'll just take it down myself. I mean, that's how expensive it's gotten, to your point. But this is how it's supposed to work, right? I mean, this shouldn't be a surprise to anybody. I mean, the Fed raised rates at the fastest rate in 40 years, and now it's having a constraining effect on, the weakest players in the economy. And it's all going to plan. It's just, it always takes a little bit longer than you think.
So that coupled with the concentration, again, let's just kind of go to this Mag 7 for a second. I see Apple is nearly $3 trillion in market cap. It's up nearly 50% on the year, and it's near an all-time high. Microsoft, same thing, near $3 trillion. It's up 58% on the year at an all-time high. Alphabet is up 50% on the year. It's not there. I mean, we're doing the math. I mean, so we're talking about $13 trillion in market cap, 7 stocks, 30% of the S&P, 50% of the NASDAQ 100. We talked about the easy comparisons, especially with the cost cuts this year. 2024, a higher for longer environment. You know what I mean? Let us assume that's how we start the year, at least through Q1. And Guy talks about this a lot, right? So these are huge beneficiaries of passive investing. They're also, deemed to be defensive. They also are self-funded. There's a whole host of things, right? They look great, right? But you just talked about sentiment indicators, and you talked about the sorts of things. Like, I've never seen more of a one-sided trade to the sort of magnitude, you know what I mean, in the markets. Like, what sort of risk is there? We have a lot of people who, we've been talking about this a lot for the better part of the last couple of years, but it seems like it's really worked well on the way up on the markets. It didn't work well last year. At last year, the S&P was still making highs the first couple trading. And it was when these stocks joined the party is when it was a definitive bear market, in my opinion. So how much risk do you think is in this concentration, and how is it different? Because a lot of folks will tell you at every, past bull cycle, we've always had this sort of concentration. I think it's a little different this time.
Well, the only other time it's been this concentrated, and I saw this from somebody on Twitter, they posted this, and credible source, but the only time it's been this concentrated was Nifty 50, 73, 74, and then in 2000. So this is the third time, and we kind of know how it ends. I mean, you basically, now the bad story is that these stocks will have to get re-rated. Okay, the good story is that capital will get reallocated to other parts of the market. And so, like, as pessimistic as I sound right now, I'm actually getting excited finally. Like, because I think we're getting closer to that pitch where, valuations will get smoked, and then you can actually do the rotation that I really want to do, which is go buy the small, medium businesses that are going to survive and are actually on sale. And it can grow.
But that's what we were kind of hoping for just a month ago at 4,100 in the S&P.
Right.
When you think about it, we're like, can we make a quick shot down to 3,700 or something like that? Because then there will be a lot of unusual values in a way. I mean, I didn't even get to the Alphabet and the Meta. Those are kind of reasonable. I'm going to say this, Amazon versus its expected growth. It actually looks more reasonable on a valuation basis than it has, I think, in a very, very long time. There's a lot of great secular stories out there. I think the last couple times you've been on the pod this year, we've talked about the hype in and around AI. We know that these stocks will not be able to live up to the hype of 2023. At some point, there will be a reckoning in the next, call it 3 to 12 months or something for many of these stocks. And some of these big ones, they were down 15% at their lows about a month and a half ago from their July highs. So could they be down 25%? Of course they could be, And I think the problem that I have going back to guys, VIX at 13 or the S&P at 45, 50 or whatever, there's nothing being priced in for that. And with the S&P on your 2024 estimate, right, for earnings, we're trading at like 20 times right now. Seems kind of expensive, and it's kind of top end loaded, right?
That's right. And so, like, it'll get reset at some point. It was in the process of doing that, like I said, in September and October. I felt like we were on our way, and then we got interrupted by this, year-end rally driven by bonds, and so we got to deal with that. Is it frustrating because we got to wait a little longer? Yes, but I think the mistake, what I think listeners really need to understand is don't get caught up in the momentum. Okay, like this is not the time to be adding risk because you just had a 10% vertical move. Like, come on, guys. I mean, like that's basic, but it's human emotion, it's human nature. You want to buy something that's up and to the right. You don't want to buy something that's down and to the right. It's just hard. And but this is the time you really got to be disciplined.
Before we get out of here, and not to play stock market, but the energy space over the last month has seen at least three major, the last of which Occidental buying a private company. Obviously, we talked about Exxon and Chevron. Collectively, they probably add up to about $120 billion-ish. Is that it's not a bad sign, I understand, but is those the type of green shoots you'd be looking for, more M&A as we get into next year? Yeah,
I want to see more of that. I want to see it broadly too, right? I want to see M&A because like the buyer, once again, companies aren't stupid, right? They're not buying stuff because stuff is expensive and they can't make it work, particularly at these financing costs. So that'll be part of the bottoming process, and you'll know it's real when you see more transactions both in the private market and the public market. So it's a start, but it's very narrow. Like you said, there's a handful of deals that are happening. We're so quiet on the deal front right now. It's kind of boring.
And Mike, just real quick, because I think part of this, if you want to put a bullish hat on at all, is that the U.S. market on a relative basis is the sexiest market. When I say that, there's no growth in China really to speak of. It's slowing dramatically. Europe's been in a recession, at least most of it has been. You got issues in Japan, right? They're finally coming out of, getting some type of inflation, but growth is now moderating again. So I think part of it, but how do you look at that relative to say, okay, I can understand that you would allocate more to the U.S. Like, how much is that, count into the valuations you think? Or how do you, it's hard to pin it down. I'm just curious your thoughts on that in general.
Well, absolutely. This year, it was supposed to be the year of the China reopening, right? It was supposed to be the big year of international stocks a year ago. And of course, that did manifest itself. So that just drove more money into the U.S. So the dollar's been stronger for most of the year until recently, and it's been a capital magnet. The U.S. is still by far the dirtiest or the cleanest shirt in the closet, and for that reason you pay a premium, and because it's so bifurcated, you pay even a crazier premium on some of this stuff. But it all makes sense. It's like a virtuous circle. It doesn't have to be calamity when we have a correction. Okay. But it would make our lives a lot easier if we could just get some clarity on, kind of the end of this cycle. Then we can know what the Fed's going to do, and we can kind of make decisions. Because, the Fed not having, finished their rate hike cycle has got companies frozen too, right? I mean, and that's not healthy, right? The companies don't want to hire, they don't want to spend CapEx dollars because they don't really know what's going on. And so I think we just need some finality to it, and that will loosen up purse strings. It'll loosen up activity in the private economy, not just the public economy.
Michael, it's always an honor to have you with us. Thanks for joining us. We wish you obviously continued success. Again, congratulations on that ranking. It's extraordinarily well-deserved, and we look forward to talking to you in the first quarter of next year.
Thanks, guys. Always great to be here.
Thanks, Mike.